Hi, my name is Felix Fry.
And I'm Marco Rajnica.
We're here to find great trading opportunities that target 150 to 400% returns. And you? Well, you're going to help us do it every single day. So welcome. This is the Winning Picks Podcast. This podcast is for educational purposes only. OptionsGeek LLC is not a broker-dealer. OptionsGeek LLC, Felix Fry, and Marco Rajnica are not registered investment advisors. Keep in mind, options involve substantial risk and are not suitable for everyone. Please consult your own investment advisor before doing any trading. Make sure you read the full disclaimer at the end of this episode.
Hey, yep.
Marco, what's
How's it
going
going?
on? Boy,
Good, I'm good.
Thank you. How's it going?
All right.
Good.
Nice.
All
Yeah,
right, good.
good. I mean, UOA hasn't been that good to me today. Whenever I click IV up, I don't see many stocks.
Yeah, we could talk a little bit about that. I saw the same thing. Yeah. But you know what I think? I think what's important, since we talked about it yesterday and then today, it's just more news out. We talked yesterday about DXC.
Yes.
And I was made aware after the close. I saw that the stock had traded down, and then you looked at the news, and Atos essentially said that they were going to walk away. And I think when I look at that, now someone says, "Oh, that was a terrible trade. That was a terrible trade. Potentially idea that stunk." The fact that trade didn't work out for people who did it. Najarin was out there pushing it. People were out there pushing it. Doesn't make it a bad trade. It's very, very important to understand that, given the information going in, that person, whoever made that trade, had some reason to make that trade.
Yes.
Okay. And the idea, in my mind, the way I look at it, is that person probably had an inkling that something was going to be happening soon. Okay. Probably. I don't know. I mean, I'm just looking at, it's very coincidental that someone comes in and buys 10 to 15,000 call options, call spreads, a position very large that's 5 to 10 times the size that DXC generally trades. And then a couple hours later, there's an announcement from the buying company that says they don't want to be involved anymore. It's all too coincidental to me, and I don't believe so much. I kind of handicap it. But what I would say is that we looked at the DXC yesterday, and there was a pad of $1.25 to make 375. So 375 if it's a winner, $1.25 if it's a loser. That's a 3-to-1 payout, right? The situation was that perhaps someone understood there was this meeting or something was going to be happening, or there was some timeline where they had to respond and they knew that they were going to respond. So if it's a 50, maybe it was coincidence and people just knew that they were going to make a decision in the next 2-3 weeks. If the decision is 50-50, it's either they're going to agree with the shareholders that are basically saying, I'm not selling to you at a low price that you think. I'm gonna wait till $60-$70. I'm not selling right here. And it's a 50-50 shot that Atos says, okay, we'll do that. Or, you know what? We took a look again. We're gonna back out. 50-50 is like heads or tails. So if I said to you, do you want to flip a coin for heads or tails? And you said, sure, what's the payout? And says, well, if you win, it's 3. And if you lose, you only lose 1. Then you're going to say, I want to do that trade every day, all day. Let's just play. Right. And so think about what has transpired. So they have this situation where it's 50-50. They're doing a trade that is payout of 3-to-1. And you look today and they got out of the trade today. It looks like at around 70 cents. So really in hindsight, they were risking, they paid $1.25, they lost 75 cents. But if they would have won, they would have made probably close to anywhere from 3 to 375, right? So you're talking about, it really wasn't 3-to-1. Like it was actually a trade. It was about 4.5, even 5-to-1, 375 to 3/4, 5-to-1. So it looked like 3-to-1, but because after the decision, they were just going to get out. If it was wrong, they'd get out. They took their loss and said, okay, fine. But it's important to understand that I think that was a great trade in hindsight. Looking at it, saying, wow, they actually got their event. The event was negative, but they only lost 75 cents on $1.25. They got out, and if they would have won, they would have made 375. They're going to do that trade every single time. And that trade really highlights what we're doing here.
Mm-hmm.
What I'm doing with the trade ideas that I send out to premium members, what we're doing here when we're highlighting trades with you, what I'm trying to teach you to look for is risk reward. Forget about the direction for a second. Risk reward. I'm risking $1 to make 3. What's the probability of me winning? Well, with their research and their ability to dissect that situation, they probably have a lot more information than we do on perhaps when ATOS is going to respond, right? And so if it's 50-50 or close to it, which seems like it's either a yay or a nay, then that's a trade that's great risk reward. And at the end of the day, that's what we're doing at OptionsGeek. So I wanted you to, it's real, live. It's going on right now. It was a trade we talked about yesterday, dissected it. There was an announcement yesterday that you see the person comes right out of the trade. The minute the announcement comes, they're not thinking, they're not saying, oh, maybe it's going to come back. Maybe no, it was a very specific thing. They were waiting for that answer. Yay, nay. It was nay, sell it. 75 cents we lost. Let's move on to the next great risk reward trade. Is that fair?
Yes.
I want you to make sure that you understand that. That if someone says that was a terrible trade, I said that was a great trade. Yeah, but he lost. That doesn't matter. You want to do that trade a million times, right? Where you got a 50-50 shot on a coin flip and you're going to get paid 3-1. That's what you're looking for. Okay?
Yeah.
Good.
Yeah.
So let's go to a couple that we're seeing. Let's what did you see first? I'll tell you the ones I saw later on.
Okay. I see in CLDR, Cloudera, right?
Cloudera. Oh, okay. Yeah. That's what I did see as well. So they're buying some big options there. Okay, let's take a look. Let's take a look at can you see my screen?
Yes, I can.
Okay. Let's go to Cloudera. All right, so stock up 7%, and these things are waking up here. You see the IV change is up.
Yep.
Okay, here across the board. So that's clue number 1. Clue number 2 is, let's remove this for a second. Clue number 2 is volumes are up significantly. Okay, where are they trading? I'm not going to look at this one because this is a little bit more day trading and people just trying to get that quick momentum. Maybe February, I can just get a peek to see what they're buying. Okay, looks like there's some open interest, so maybe they're just shuffling things around or taking profits here. Not sure. Again, 2-3 weeks, not so exciting. But I'm going to look at this one, 23,000 in August.
Yes.
Okay, in August. So you generally don't get that, that type of volume in this name in August. Up here, sure. Down here, no. So we quickly see that spot's very clear. So this is clear. This is clear now. So we could just click on this, and now we can dissect what looks like a clear buy. Just from eyeing it, it looks like a clear buy. Stock shoots up from 16 to 1740 in a matter of 15 minutes. The IV goes from 69-ish to 77 in a couple of minutes. It reaches 80. You could see here, 80 is the high right now. 79. But it's coming from 72, 73. So it looks like the stock was coming off a little bit today, but then this shot up. So this to me looks, I think it's pretty clear. It was buying, but I just want to verify. We want to see that right around 1018 here, 1017, 1018, buying. 267, 285, traded 70.4. Then the vol just started trading up as these buys started clicking away, 75, 76. And so this is all going up as this is going up. You see this 1 minute. This looks to me like it's a computer. So it's a computer. Paying. And what did I tell you? IV doesn't matter, right? I tell that all the time. Doesn't matter to these guys. This guy has no interest in IV. He literally just paid. He paid 70, 74, 75, and it's a computer. He's just telling the computer, keep buying. 353, 356, just whatever it is, keep buying. 72, okay? I don't know when it stops. It might be all day type of thing, but the reality is that you can see this is crystal clear proof that these guys are not caring about implied volatility. What do they care about? This number, premium, okay? That's what they're paying. That's the risk they're taking. Now, is there better ways to maybe do this? Maybe, maybe there's a better way to have done this. I'm not saying that not caring about it is always the way to do it. Not caring about IV is always the way to do it. I'm simply saying that they don't care about it as much. If their average price is going to be 375 or 390, they don't care because they're thinking that on a risk reward basis, this is going to be $12, $13. Okay. So it's just important to see when I need, when I say IV to the top guys doesn't matter as much. I do say it doesn't matter, but they'll look at it. But this is proof. This is showing you this guy is not looking at this number. He's looking at this number, the premium, and that's what I tell you to focus on. Okay, so he's paying $3.75, $3.80, $3.95, almost $4 for these options. The question now becomes why. So we've isolated CLDR as a buyer, right? You agree?
Yes.
Okay, now we want to figure out, what is the guy thinking? Why buy the 17.5? So first thing I want to look at is, what is, to buy the 17.5 today, what did he have to be thinking as far as price? And we look at that in August and, call it 30, right? So right now it'd be around $30. Seems high, but you're talking about a 17.5. It's a little bit out of the money still. And you got this number coming from back here. Okay. But these numbers, the higher you get in one thing I would say, the higher you get in volatility, as these things go through 70, 80, because the Black-Scholes formula is a closed environment. Okay. And I don't want to get too mathematically technical. These numbers start really trending towards zero, right? So for example, just to give you an example, if a stock is 100, right? Stock is 100, and I told you that the volatility was 200, 300%, then what is that going to do to what is the probability in a mathematical sense? What is the probability of the option, being above 120, right? And if you think about it, okay, because if now you just use common sense and say, okay, well, if the stock is moving annualized at a 200% rate, okay, so 200 vol or 100 vol, the higher you go in volatility, the more that a model is going to say, that's dealing with percentages, the model is going to say that it's going to trend to zero, that this stock will go to zero. That mean in real life, that's probably not true, but it's basically saying, mathematically, if a stock goes up 100% from 100, goes up 100%, let's call it 90%, just to give it a little bit some room. So we call it 90%. If the stock goes up 90%, that's how much? 190, right? 100 to 90% gets it to 190, right? If it goes down 90%, where does it go to? It goes close to $20 there, right? It goes to $20. Now at 20, it goes up 90%. How much does it go? Oh, now it's going to go up to about $38.
38, right.
What if it goes down 90% from $38? From 38, it's going to go down to, about
dollars, yeah,
a couple of bucks, $5, call it. So that's the math, and that's why when you're looking at percentages, you have to know what you're looking at, right? So I'm trying to teach you right now that just because the formula says something, you can. It's like a plane, right? The planes, especially today, they're building these planes where they fly themselves, but they still have a pilot just in case something goes wrong. This is, I'm taking the handle here and I'm going to do this, this, and this to make sure we're okay because I've got control. So in any tool, it's important to understand how the tool is built to sort of say to you, hey, this is acting this way because the volatilities are so high right now. So in this case, when I stick in 30 and I get a price of right around here, because I know that the volatilities are so high, and if 17.5, that should be closer to 50%. But because of the model is pushing the percentages this way, then I'm going to actually go a little bit lower on where I think that option, where this pointer is, right? I might even keep it, I might go here, let's say 28.5. Let's see if that does anything. 25. Okay, so 28.9. Call it 30. So it wants 30, but I'm going to move closer, right? I'm going to start looking more at these numbers, okay? These numbers as opposed to, maybe this particular strike. So if I say, at 28, what type of return do I get? At 17.5, 20, these returns. So I might look at a target stock price closer, if it says 30, closer to 27, 28. Okay, that's how I would think about it. So it's just to give you, it's massaging the numbers a little bit because the numbers are being skewed because the volatilities are so high. So I would say it's closer to 27, 28 as opposed to 30, giving it some room. And that's sort of my first step here. So 19,000 options just to review, being paid 375 of the 17 and a half calls. Person's probably thinking closer to 28, 27 to 28. And now we can go to our chart and look at CLDR, CLDR. Just to get a picture of it, here's a 4-year picture of CLDR. You see what I see. Looks like IPO'd right around here. Went to 23. That's the high. Someone is now looking for, let's go here. And let's go to 3 years. Okay. Someone is looking for a big move here into August. So they're looking above the 23. You know, I would say the first thing that pops in my head here to think about this is that that's a lot. It's a lot to play. It's a lot to pay. Sorry, it's a lot to pay for a $17.5. You're paying $3.75 for a $17.25 stock. So you're talking about 20 something percent here for that stock. That's a lot. So my first thought is the person buying these calls to sell his stock? Okay. Now I look at the chart and see, somebody could have bought stock in this range. You see here, there's a couple areas, COVID, right? But here's where this thing hasn't done much in almost 2 years. Okay. So, you know, stocks down here, people are selling as things are not doing well for the company, or it's not moving as best they thought. And that, you know, this is a collapse here. And there's a lot of volume here. Okay, so maybe the average volume is 7.5. Stock goes from 7.5 after a year, after called 16 to 18 months, to 17.25, and I paid 7.5. Maybe I want to get out of some of my stock, okay, and sell some stock and buy some calls. Maybe. What's racking in my brain is that that doesn't make, if it was a $60 stock and you bought it at 20, 30 and it's moving up, this is a lot for a $17 stock. That means the person has no confidence that, you know, or doesn't think that you're paying for almost $4. So $4 less 17.25 is 13.25. And, you know, the person is saying, I want to be protected down to 13.25 on a risk reward basis. I have a hard time believing that. I'm not really sure about that. I guess that's sort of racking through my brain. Now, do I want to buy the stock? Now, that's the question that I'm asking myself. Do I want to buy the stock? Well, one thing I hate is chasing, right? I keep saying that. I don't like chasing. I don't like situations where I'm chasing on this. Here's what I definitely don't like. I don't like situations where I'm chasing on the stock, right? I'm chasing on the option, and I'm chasing on the implied volatility. It's like a triple whammy, right? And it makes it very difficult to win. So we have a stock that has moved from 10 to 17 in 8 weeks. We have options that are trading near the, you know, you're trading near the highs, and now you're trading for another big leg. Okay, so this is another big leg. And then on top of that, you have implied volatility that I can do some digging and try to figure out where the implied volatility was. But I suspect the implied volatility is a lot higher than where it's been, because now it's become a hot stock. And so, you know, the volatility is probably at its highs. I mean, this is 1 month telling me here that it's already, you see that it's close to its highs. But maybe over the 3 months, 4 months, it's probably maybe a little bit higher. 1 month is here, maybe 3 months is here. Also, calls to skew, you know, for upside calls is super bullish. That means the calls are skewed higher. That means if you want to buy out of the money calls, they're bid. They have been bid. They're trading in a 3 month on a 3 month basis. Meaning, if I looked at the last 3 months and looked at skew of the last 3 months, it's almost at the highest today, right? So, you know, I'm reaching not only implied vol, I'm reaching on skew. I'm reaching on the actual taking right now the opportunity to buy options, and then I'm reaching on the stock being up $7. It's across the board reaching. Not super exciting. What would be more exciting, okay, because this is now on our radar, CLDR, on my radar, on your radar. Stock comes back down to 15, 14 for whatever reason. Market just happens to come off. Comes back to 15, 14, and I want to see that buyer step in again. When I see a buyer the second time now coming in again, okay, you know what? there's something going on here. I'm leaning toward yes, I like it. I don't like reaching. I see someone here buying because we looked at it here, the 10. I see somebody buying some options in May. Is that right here?
Yes.
May
yes.
22s, right? May 22s. That's really high. It's up there, right? It's up there as far as price, 22.5 to pay $1.38. He's got to be looking closer to 30. Let's call it $30, right? Right around here, $30. So you got someone looking for $28, $30. They're buying options. That's all targeting $28, $30. You know, it's interesting. It's interesting. Now that's so we've looked at the options. We've looked at the charts. Can it get there? I mean, this is a little stretch. Can it get there? Traded 23 at the highs. It breaks 23. Who knows where it can go? Now so obviously this chart right here is bullish, and it looks like a turnaround from a disaster from several years ago. So technically, yeah, it looks like a great chart. It looks like a momentum chart. Someone's coming in. On the options, we see what they're targeting, 27 to 30, and they're buying further out options. So they look like it's basically saying it's not next week. They are buying next week options, but it's these guys who are buying the August, they're saying, give me some time. This is going to need a little bit of time. Then I'm going to look at the story. So the story is, because we know this, the story is Carl Icahn is also involved here. Yep. He's the number one holder. He's been holding for a while. He likes the stock. Okay, that's obviously a big name. He's an activist. They used to call activists corporate raiders. He's an activist. He comes in, he puts people management on the board, try to turn things around. What's happening with CLDR? So we can look, obviously a software company, but it's a software company. Sorry, let me look at Seeking Alpha. It's a software company that I know has not been in Wall Street's graces for some time. So if I look at, sometimes we'll look at this where has Wall Street missed the momentum, right? Has Wall Street missed what the story really could be? Mm-hmm. And what I do is on occasion you might look at Wall Street ratings and you say, like that's interesting right now because the stock is bullish. Stock is starting to move. And look what you have here. Out of 15 people, 10 people are, call it 66%, almost 70% of the people are just neutral. And the stock is starting to move, right? You got a CEO who's changing the whole face of CLDR over the last few months, turning it into, you read the transcript, turn it into public versus private, look, I'm not an expert in all this stuff. I'm going from high level of what I understand. Essentially, CLDR was, for the most part, on-premise, which to me sounds like they were putting their software and using their technologists to come to the firms and build within the firm and help the firm build on their own solutions using their product. Now they've switched that and they've actually put the product in a cloud. And so now they can just get a subscription from many different customers into the cloud using their products. That's what I get. As far as the type of product, my understanding is that it's a data product, data analytics product. They make it easy for a user, a company, to take all their data from all different points of the company and analyze it with probably visuals and probably just the way they put it out. That's what I get. That's at a high level. I don't know much else, but I do know Carl Icahn's in. I do know that Wall Street is behind the curve here. I do see call option buying. On the negative side, the stock is stretched. The options, the positioning of where you're trying to buy the options seems stretched. Implied volatility is stretched high, and skew calls upside is bid. I'd like things to calm down, essentially. Okay. Mm-hmm. So I like the story. I like where it's going. I think it's, I think because big data, and this is also data analytics, because that's been hot over the last couple of days. And you're seeing, you talk about anything AI data, Snowflake, Palantir, all these types of technology companies, they're warming up. People are starting to understand how powerful this stuff is. Not starting. I mean, the big guys, they know, but I think it's a harder story to tell the next person, but these things could catch significant momentum. So mm-hmm. I like it. I like what we're seeing here and what you found. I'm a little concerned. I would put it on my radar and I'm going to watch, just because me personally, I don't like jumping. That means this stock can go from 17 to 30. And you know what? I'm making the decision today that it just seems very expensive. You know, 17 to 30 is a double on CLDR. The stock just doubled essentially, right? It went from 9.5 on the low to 17, almost a double. So it's got to double again. I don't know. I'm gonna hold back a little bit. Is that fair?
Yeah, that's
okay.
Fair. Cool.
Okay.
Cool.
So let's look at another one, because another one that we talked about just before.
Yes, it was TEVA, right?
TEVA, right? TEVA. So that was a good one. So you found this TEVA. So what I like already about this is that you found this TEVA a couple of weeks ago, right? And you know what I always tell you is that repeat buyer, you know, is always interesting. Someone comes in to buy options one day, time goes by, and then they come back in, or there's somebody else that comes in to buy options. Remember how the billionaires buy options. Remember how they think. They're just like you and I. Except they have power, money, and they're putting all their resources to get good ideas. They get a good idea. What do? They basically buy it for themselves, either in stock or options. They buy stock, and then they have to make a conscious decision to say, okay, I want to buy some options. So they buy options for the leverage because they think there's going to be this outside move. So they do both, or maybe they just do one. But likely here in this situation, they're probably doing both. They do both, and then a couple of weeks go by. What do you think is happening in those couple of weeks? Like everybody else, like what's happening everywhere that you're seeing right now, Wall Street, but anywhere, they go tell their friends, the next billionaire, and they're having lunch or dinner with the next billionaire friend, and they say, are you looking at TEVA? And billionaire friend 2 says, I'm not. Says, well, you should look at it because of 1, 2, 3, 4, 5. And this is what we're seeing, and this is what we're thinking. That's interesting. And you know what? I'll have my analyst tomorrow call your analyst, and they can get together and put their minds together and see if they can come up with something different. That's how it works, right? It's you know, one billionaire to the next. Now the next billionaire goes and does his work, and guess what happens? A week and a half later, the analyst says, love this story. And billionaire 2 says, you know what? Let's go buy some calls. Go buy that call, and that call. Okay. So behind the scenes, it's sort of this, you know, this story that starts moving, you know, like a pyramid down this way, and people are starting to hear the story, whatever that story is. Or it's scenario 2, which is the same guy just says, you know what? I like the way the stock's trading. Buy it again. Buy another, get more of this on because I'm hearing good things or whatever, and you know, more people liking the story. So what is the story there in TEVA? We talked about it before about the opiate crisis. This guy, basically, it's the CEO. He's really good. Kari, what's his name? Kari something. We were looking at it before. Kari Schultz. Kari Schultz. So what I would do is, again, Seeking Alpha, they have some awesome stuff. I mean, you can just go there, click on TEVA, and I believe this is free. You can just see the JP Morgan Healthcare Conference on January 12th. Here's the CEO, okay, the CEO, and he's being interviewed by this person. And I mean, he lays it out. He lays out the story for TEVA right there. Now, he has a bullish bent because he's the CEO and he wants people to come back into the stock. The stock has gotten drilled over the last, call it, this is going to be here. Let's go 10 years and see the story of TEVA. The stock has gotten drilled. Now, a lot of this was the opioid crisis. Okay, and it went down to $5, $6, $7, which is it's here. So this would be a turnaround if they could actually get back into the graces of Wall Street and say, hey, the past is the past. They still have lawsuits, and there's still an overhang on the stock, and it probably will be for many years. They did price fixing. That stuff doesn't go away. It's just going to be an overhang on the stock for a while. But you know, if they come out with any announcement saying, you know, we're settling with it, we're trying to get this behind us, we're settling on this, or we're settling on that, that will make the stock jump, take these jumps. You know, maybe from 12, the next stop looks like to me would be 17.20. And so when we see the call buying in TEVA, and we see something like the March TEVA options, you know, 14.15, they're actually thinking higher. Now, I'm not sure I'd have to look a little bit into the open interest here, okay, on when that changed. But you know, they're starting to come after these names. And the 15, this might have been sold, but for whatever reason, now, you know, this is coming in to buy today. It looked like this came in right in the morning to buy. Vols came in again. The implied volatility was higher. So net, I would say that there's something there's a story floating around in TEVA within the community, the hedge fund community, or the big funds, that this guy is turning it around. You can read this Seeking Alpha article. Okay, just click TEVA, and it's right here, free. Okay, and that's the CEO speaking at a conference, and he talks about 3 drivers of the stock going forward. He talks, interesting enough, about some of the things that have hurt the stock, and how it's no longer. For example, you have a drug that's you're selling. It has $4 billion in sales, and the minute it's running into trouble, $4 billion goes to $2 billion. That hurts. Well, when the drug is $500 million in sales and revenues are going to be down another 20%, $500 million to $400 million is, again, it's just not as much as it was when it first ran into trouble. So part of his story is, hey, the damage has been done. We're turning around here. Let's focus on the 3 drivers of the stock for the future, and this is why it's going to go up, and this is why. Now he doesn't like addressing. You could see in his earnings transcripts, and here, the minute you start talking about the DOJ and price fixing and all the bad things, he says, we have another guy to talk about that. He could talk about that. So it's interesting. I mean, but this is the story. This is how you have to, dig in and start paying attention. So TEVA is something that I like. It's interesting to me, and I see the call buyers, and it's the repeat call buyers. So this one, I'd have to look at this. Now let's just take a look at can click here for the open interest just to see 12 to, let's call it 20, right? 12 to 20 and top 5%. I'd like to see where the volume is, okay, and where the bets are being made here. So you could see clearly that $12 is a big level, okay. And what I'm doing here is creating these sort of markers as to where people are taking long-term bets in TEVA, right? So when did they do this? At what price? What price did they pay here? Is this a call spread? Is this a 12-17 call spread? I would look at that. These are the types of questions I have just by looking at this. And now I have to look at the history. I'm going to have to go back into the data and start clicking. I don't have that right now, but into the data, I would have to start clicking. The other thing I'd like to look at. So these are calls. Let's look at puts. I just want to look at this one here. I click on the expiration. I click chart to kind of get an idea of what it looks like. And it looks like, again, it's heavily leaning on calls here. Okay, heavily leaning on calls, the 12s, the 13s, even over here. And then over here, you have only a few thousand options. This is nothing on a $10, $12 stock. That's nothing. So, clearly the bets are being made here, and I'm trying to show you and help you visualize it, on each side. So we're looking there. And I would basically, keep in mind that what happens after February, these go away. Okay. And then you got March. And so people are starting to buy, calls. The stock's trading, here, but people are starting to buy the 14, 15s in March, June. This is interesting, right? Because this is going to go away, and now the upside is starting to be up here. Maybe this is a call spread, but again, this is good to look at just to show you where the bets are being made, how they're being made. If I look at puts, again, there's nothing in puts. So over here, these are the 10 puts, but I think this is when a lot of these puts, especially in the Januaries, a lot of these puts could have been done even 2 years ago when people thought this company was going to go out of business. Same thing over here. But again, I would look into those to just see when they were bought. Were they bought on the way down? That's a little bit different. That's a little bit different than if they were bought 2 weeks ago and people are looking at the 10, they're buying 40, 50,000 of these puts. So again, that's how history of the trade and history of the story helps informing, an opinion. So
nice. And we actually got a comment from Pam that I want you to take a look at. And Pam says that.
What does Pam say?
Yeah.
I bought a full lot of TEVA March 12 when you first mentioned it. Is it up? It is up 71%. And the question is, what should I do?
No, that's right. No. Sorry, not the question.
Pam, I love it. Good. I love it. I'm simply, we're trying to stick out things that look interesting, and again, it's something that, to me, it looks like there's something there. to me, it looks like there's something. It feels like there's something there, right? It feels like when they come back and they're buying and they're trading around the out of the money options, and you see them trading in chunky trades. You see the stock trying to have this turnaround here. This is a big level. We talked about it the first time, 12 and a half. Gets through 12 and a half. You're going to see 15, 16, 17. I think fairly quickly, that range, 15, 17 and a half. So something to look at, something to keep in mind. Let's go to the next one.
Okay, sounds good. All right, so the next one is so Norwegian Cruise Line, I guess. NCLH.
Yeah. The old Norwegian cruise lines, huh?
Yeah, they've been hit hard. I mean,
yeah. So the thing about these guys is, like, do they get the government help or not? They probably do, because the government doesn't want industries to go under. Let's just want to set the stage here a little bit. Okay, obviously coronavirus has had a big problem. We all know this. It looked like the industry was going to go under. That's not going to happen. And so everybody buys in. Here they're talking about this was all COVID stuff. And then eventually the reality hits that it's just the industry is not going to open up for a while. Now the vaccines, okay, it's pushing it up and it ends up here. So the question is, what are we seeing? Okay, so what is it? NCLH?
Yes.
NCLH. Okay. So a little bit of a mixed signals here, right? You have volatility down on some, but on this one where the volume is, you can see the implied volatility is higher. So taking a look here, obviously this is the one that they're focusing on, and we have a what do we got here? 3,000, okay, several thousand. Implied vol is trending higher. $1.13, they paid at $9.49. Then at $9.50, you're talking about $121. Okay, so prices are going up. Implied vol is going up from the morning. Yesterday's was, call it in the 85 range, and now today they're paying 89. Yep, this looks to me like it's a buyer. Okay, so we've isolated a buyer here. Now the question is, why are they buying? You just told me, yes, it's likely that this is earnings here on the 18th, so right near expiration. It is estimated here right now, so we'd have to check to make sure that that's right, but it does seem right. The market, see, we talk about the IV 70 here and then 90 here, that jump. That's basically saying that, hey, we're the market makers. We know that earnings are in this week, not in this week. So we're dropping this implied volatility to this level, and this is the one we're going to focus on. We did this with Pinterest. Any option you look at, this is the relationship you should see, where it's a lot lower before and a lot higher at or with the earnings. Okay, so we have here 10,000 to 24s. Now, frankly, at $1.30, this it feels cheap. It just feels, these stocks, any type of announcement, and these things could really move. And paying $1.20 for an option like that just feels not expensive. It feels like this is something that a hedge fund, if they got a little bit of, they got some data, or they got something that speaks to Edge, might be something that is interesting here. What I would say is take a look at here. Let's annotate it. Take a look at this chart, and I want you to concentrate. I want you to just look at here, this area, and this area. Okay, forget about this drop. We know this drop, but we're in a different world. This is right now at this point, this is a completely different stock. Okay, it might as well be. We're just looking at this. What's the difference between this and this? I would say you see how this came up and came down like that? You see that? Whereas here, it came up and, it came down a little bit, but it's more like it's doing this, right? It's more like it's, kind of, this is steeper decline. This is not so steep. So I'm looking at patterns and I'm seeing, steep, these the market's it's moving crazy, and then it's moving crazy again in a bigger way, and then it finds its range. Okay, it finds its range, and then it shoots up, and this is kind of a tight sort of range here. And in general, I consider this a bullish development, because the market is basically saying, the market might be trying to do this to it, but someone is saying here and saying, I'm a buyer. I'm a big buyer, right? They're holding this stock up at these levels.
Yep.
Now someone is willing to pay the 20, buy the 24 calls. Is that what we're looking at? The 24 calls. They look like they had the 25s too for earnings. It looks like there is a buyer, or just in general. Now there should be, right? Because this is where the vaccines all, came out. This is, Moderna. This is initial one was Pfizer. Moderna was somewhere probably right around here. And, things have been, you watch the news like I watch the news. Everybody's watching the same thing. Vaccines maybe work, maybe they don't work. People are dying, people are not dying. People are starting to look for the next year as opposed to the next 3 months. All this news about vaccines don't have the same effect they were having, let's call it over here, where you have a vaccine that goes from 16 to 23. And then, it's muted. Okay. So this chart to me looks bullish. Okay. And I, without even understanding the option stuff. So net, I have someone that is buying calls on what looks like a bullish play. Okay. And it doesn't look like
at 28.
Right now. Also for a target. So let's call it 28.
Maybe and a half.
Let's call it 20. Let's call it 28 because I see that the vol is high, and we can call it like 28 and a half. Let's call it 28. Just want to make sure if that makes sense. 24, paying $1.39 on a 24. Yeah, that's about see how the at the money is about 50-50. So yeah, let's call it 28, 28 and a half. 28 and a half. Okay, so 28 and a half. I can go with 28 and a half. 28 and a half looks like it's interesting, right? It's right at where it was. So someone is looking for it to essentially just get towards the 28 and a half. And if it breaks 28 and a half, it's going to, there's nothing, it's all air. So it's going to trade higher, maybe over the course of another 4 weeks towards, 32, 34 range, I would even guess.
Yep.
Okay. Somewhere around where I tried to make a move up here, but 32, 34. Okay. So that's sort of what I'm not saying it gets 32, 34 on earnings. I'm saying it starts creating that trend. It starts creating this trend. It's got to get to 28, see what happens at 28. So what would likely happen is if someone is long stock, say someone has bought a lot of stock here, what the setup could be is very simple. And you would probably do the same thing. You started buying stock around here, 16s, right? You're buying. It gets to 28. You sell a little bit. You just almost doubled your money. You sell a little bit. And now you're here and you're long. Remember, your average is around 16, 17. You're here. Maybe you're buying a little bit more here. But what you want to do is you're setting up for a move up to 28. You're going to pay $1. Okay, you're going to pay $1. And if it gets up through 28, you might be able to sell your stock right around 28, 29, 30, whatever. You're not going to have a lot of time because this is very close to expiration. But, it's something to think about that you might, it might just give you the opportunity to risk reward balance, to balance your risk reward right after earnings. Okay, on that Thursday, on that Friday, or to do something, or to, because look, you'll be taking profits. If it's a stock goes anywhere from 27 to 25, this thing is going to make 3.5. Let's do it at 27. At 27, these make 115%. So is that right? What are we looking at? The 23s?
24s.
24. So at 27, they make 116%. So they're going to take some off. I don't think that they'd be buying it for that. I actually think that that's why we got to be a little bit higher, because they need to think 28. They're probably looking for 200%, 150 to 200. So you can play around with these numbers to sort of see what they're looking for and what they potentially want. So yeah, it's interesting. I don't like, I want to be clear. I don't like usually taking flyers, 2-week flyers on earnings. I'll do it every once in a while. It's a tough game to play. I can tell you that much. It's a tough game. I prefer the Cloudera, seeing them buying. Sorry, not this one. This is DXC. I prefer seeing them buying the Cloudera, where they're buying August, right? And they're buying a little bit further out to see if there's a trend, and then by May upside. This is a shot. This is someone saying, I think it's going to be good. I'm going to take a shot on the 24s. And if it's positive, we can get 27, 26, 27 to see it looks positive. Supposedly, NCLH, I haven't done all the math, but they were having, there's issues about whether or not they have enough cash to stay in the game for the next year if nothing happens, right? Right now, who knows how this thing ends, or how much more the governments are going to keep pushing that these ships are a worldwide thing, right? Because the ships have to go somewhere. So it might be great in the US if we're saying, oh, okay, we can get on the ship, but the ship's got to go to, they're going to Norway, or they're going to wherever they go, the Bahamas. But everything else the world has got to be open for business for these ships to actually be, international cruise lines.
Right.
So,
exactly.
I would say it's good. I don't like it's an earnings play, so it's a crapshoot. If you were going to do it, if you want to do it, maybe instead of a full position, maybe you just take a little flyer and say, okay, I'll use that. Okay.
Cool. Nice. Good one. And I think when you received an email from somebody's IFF, there was some merger.
Yeah. So I looked at IFF, and when there's mergers or there's potential takeouts, and there's it's a different game. Options become a different game. They become first of all, the banks hate trading these options when there's potential merger agreements because they're choppy. These gap moves are not very good for the banks. It's very hard to hedge these gap moves. And so when I looked at the IFF, what I did see, we're looking at February, I did see 162,000 and 162,000. You see that?
Yep.
So what that tells me, one, I saw that it was in a deal. Two, I see 162,000 on the calls and the puts. What that tells me is that would be it's a specific trade, and it's called a conversion trade. Okay. And essentially what they do is they buy the puts, they sell the calls, and they buy stock. And the reason they do that trade is to lock in the borrowability to short the stock, to sell the stock. Okay, because now they're going to be the buying puts, selling calls is a synthetic, and then the long stock ties it up. So there's no risk. There's no risk at they're not taking any directional risk. They're simply doing it so that they can get a hold of stock and they could sell it against whatever it is that they're buying. I think it was a DuPont position. So maybe there is some trade, and I haven't looked into it. Some merger, or it's called merger arbitrage. Okay, they look for specific things like this where there's events and there's an announcement, there's a deal, and they try to arbitrage that deal. Okay, so company A is going to take company B over. Okay, and they say we're going to pay $15 per share for company B. Well, company B trades at maybe $14.90. Okay, because it's a cash deal. Okay, so I'm going to give you $15 in cash for company B. So the stock trades at $14.90. The reason it trades at $14.90 is the interest on actually buying a $14.90 stock over the course of, it might take 8 months, over 8 months at 1%, it's going to be 10 cents. Okay, so 10 cents on $14.90 is how much? Is plus $14.90 is $15, which is exactly what you're going to get. So there's no arbitrage. Where there's no risk, it's called risk arbitrage, merger arbitrage. So when in a different scenario, if company A was going to buy company B at $15, but there was going to be stock, they were going to give you $15 worth of company A stock, okay, and they calculate the number of shares, then company B is not going to trade at $15. It might trade at $14 because what people will do is they will short some stock, the amount of units that they said they were going to give, amount of stock shares they were going to give, and they would buy an equivalent dollar amount of company B. And so they try to make that difference. It's not an easy game because there's a lot of regulatory issues. Also, what happens is people are trying to make a small amount, and if the deal breaks, the trade goes like, it widens out. And so you're short this one, long this one, and it breaks and it goes like this. So if you lose, if there's 4 or 5 deals a year that break, then that community who trades those particular names, you can get killed. 90% of the time, 95% of the time, they're going to go through. But in a situation where 2 companies are going to merge, and then all of a sudden something happens like COVID, and one company says, I'm out, then you see that's where the merger arb risk comes in, where there is risk. For example, you can go back and look at Tiffany's. Tiffany's was in a deal. I don't even know if they closed yet, but once they got into a deal, then all of a sudden COVID comes, and then maybe people don't want to buy Tiffany's anymore because of COVID. And so, the deal's in jeopardy. The investment bankers made company A sign an agreement that says if you go to break, it's called a break agreement. So if the deal breaks, then company A owes company B, $250 million or whatever the break fee is. Okay, so that break fee could be a lot more, could be a lot less. That goes into the equation of whether or not you want to play. It's a whole different game. So in this, I'm getting off tangent, but in this particular situation, IFF, when I see 162, that to me is someone doing this conversion trade to make sure that they have the borrow so that they can put this trade on, shorting IFF and buying whatever. I don't know what it was, but that's what it looks like to me. So that's my,
nice.
I don't even know, 4-minute spiel on IFF. I don't think it has anything to do with direction.
Okay.
All right.
Cool. All right.
Cool.
And last thing I want to address today is a question I have. And that question is, lately, since all this happened with, the situation and the hedge funds and the investment banks and all, I've been seeing that it's been harder to buy options at a certain price that I want. So like sometimes I bid, let's say it's between 110 and 120. I try to buy it at 120, it doesn't let me. I put 121 and it buys it at 123, something like that. Okay. So like crazy stuff starting to happen.
So look, this is something that we've been saying over the last couple of weeks, how I think I said medieval, like Citadel's getting medieval here. Like they want their money back, and they're going to get their money back one way or the other. Okay. It might take a little bit of time, but you better believe they're going to ratchet up the AI. They're going to make sure that, they get, if it takes them $1 at a time, they will get their money back. Okay. So how do they do it, or what's actually going on? Well, when you have a situation that's happened over the last month, it has hurt a lot of the market makers. Gapping, I just told you, gapping hurts the big investment banks. It hurts when people are buying 50,000 options and the stock gaps up $300 and then gaps down $300. You better believe that hurts anybody who's short those options. Okay. Just because there's short calls and the stock goes from 100 to 300 back to 50, that doesn't mean they made money because they're short calls. They got obliterated. Multi-millions of dollars are lost. Okay. And so the situation you're talking about really, it has, this last, call it 6 weeks, has really beaten up a lot of market makers. And what does that mean? Maybe there's, let's just call it 10 big ones, 10 big market makers, and they're all feeling the pain. Now, Citadel has billions upon billions and billions of dollars. They can take a lot of pain. Okay. A lot of these other market makers say, you know what? I'm not going to make the market so tight anymore. I'm actually going to widen it out a little bit, which leaves what? It leaves room for the big guy, Citadel, to sort of decide where they want to make the market. They step in and say, we're going to be a little bit better. But by being a little bit better, they sort of start, not only do they see the orders, now they actually control exactly where it's going to trade, right? And what could happen, in these situations is what you're seeing is the best bid offer. So when you're looking at 110 at 120, that is the best bid offer across America. Okay. That means, the best bid is 110. Maybe it's in Chicago. The best offer is at 120. Maybe that's in San Francisco. I don't know, but it's the best bid and the best offer. Now, where's Citadel? Citadel might be 110, 125, maybe. What you're seeing, Citadel's not at 120. So when you go pay, you want to buy a 5-lot at 120 and you go pay at 120, that option has to go into one exchange. Now, there's a lot of technology now that people are using to try to send it to several exchanges, but there's latency, and it's all technology. You're talking about milliseconds to get from one to the other. So what they do is they basically rifle, one of these, let's call it broker X, whether it's Robinhood or TD, they might have a situation where that they're sending it to all different exchanges, or they've asked Citadel to send it to all different exchanges. what happens is that they might take the one lot at 120, but the minute they take that one lot at 120, what happens? The whole world, or at least everybody in the United States, knows that there's a buyer at 120. Okay. Now these aren't people. This is computers. So the computer says somebody just paid 120. I'm now at 121, 122, 123, and everybody moves up a little bit, even though it's a one lot or a two lot or three lot, because remember, they're trying to make as much bid offer as they can. That $1 at a time, they're going to make their money back. So they're very careful now. It's like, okay, somebody traded at 120. We're going to move 120, 122. Now your limit bid 120. And you're like, everybody disappeared. I got one. I wanted to buy 5. What happened? Like, you're upset. Well, you bought one. You bought what was there at 1. And then all of a sudden, sometimes there is all 13 exchanges. I think there's 13 now, 15 exchanges. Say all 13 exchanges have 5 lot offered at 120. Okay. All 13 have 5. Maybe one has 1 lot. So it's 1 and 12 others have 5. And this machine sends it, you put your order to 120 and it goes and takes the 1. And then it goes to send the other 4 to the other exchanges. All those exchanges that had 5, they move it to 122, 123. And now you're like, wait, what happened? There was, 13 times 5, which is 65 plus 1. So there was 66 offered on the offer. I went to buy 5 and I got 1. What happened? Well, I'm telling you what happened. The minute you bought 1, all the other ones moved up. Right. That happens in milliseconds. Now we're using 1 lot, 2 lots, but people trade 100 lots, 20 lots, 30 lots. Right. They're not going to give you that price if they think you're going to pay up. So the next question is, because I know people say, well, what exactly is happening? Well, there's a rule, which is really interesting. There's a rule that also allows, like, these market makers, they have to, on their side, and again, I go back to that Robinhood video that we did, that series that is important to understand. On their side, they're buying and selling stock versus the options. So when you trade calls, they go buy stock. You buy puts, they short stock. You sell calls, they're selling stock. This is how they do it. They have to do it. That's how they're managing. Citadel might be so big that they don't even do that anymore. They just kind of like, they're managing a much larger book. But the computers, you can believe you're coming in to buy 5 lot of a company. That's how many shares? 500 shares times, let's call it a delta of 50. So it's about 250 shares that I have to buy. If you come in and bid, the market's 110, 120. You come in and bid 118. Okay, limit. I don't have to sell you any. The minute I post, I'm Citadel. The minute I post your order on the exchange, so the whole world could see it. The minute I do that, the millisecond I do that, I am allowed to actually buy the stock in front of you. Okay. Did you know that? Did you know that?
No, I do. I do.
Most people don't know that. Right. But the rule is, it's a law. The rule is I have to show the option to the world. I can't buy the stock and then show the option to the world. But because of technology, that millisecond might as well be 10 hours. Okay. So I'm allowed to put it somewhere on an exchange, and then I can go buy the stock on a limit trade. Now, I'll leave it up to you to make some conclusions, but do you know that there's an exchange? I think it's the Miami Exchange. And over the last 5 years, 3 to 5 years, it's become one of the most important exchanges where a lot of volume is trading at the Miami Exchange. 15 years ago, it was either the San Francisco, it was either Chicago, it was but no, there's a new exchange, the Miami Exchange. Now, given what I just told you, that the minute an option is put down on an exchange and everybody could see it, even though it's a millisecond late, okay, I'm allowed to actually buy some stock. Not front run. That's not front running. I'm allowed to do it because everybody sees the same order. Now, why would the Miami Exchange become the biggest? That's the question I had. When I saw the numbers, you can look. Why would the Miami Exchange become the biggest options exchange? Like, what's going on? So I look into the Miami Exchange. Maybe you should go look at it. Who owns the Miami Exchange? Who's the owner of the Miami Exchange? Who are the investors? I think it's surprising or not surprising to know that I think Citadel, and I'm not sure, I think Citadel is the owner, is an investor in the Miami Exchange. We can look at it. I mean, let's look quickly here.
Okay.
We'll do it live. I remembered that I thought Miami Options Exchange. Okay, here we go. MIAX. And let's take a look at investors of the Miami equity investment. Okay, so they got equity investment, completes equity investment, Miami. Let's just see. Let's just put investors Citadel. Citadel pops up. Miami Exchange enters 2017 equity rights transaction with exchange members, including Barclays, Citadel, Morgan Stanley, Optiver, Susquehanna, all the market makers. Now, why would these market makers, make Miami the biggest exchange? They want to trade there, and they want to trade and have access, because on the Miami, you can do whatever you want. And there's nobody else there except the market makers, right? Except a few of these electronic guys. But why wouldn't they do it on the Chicago, on this and that? They wanted their own exchange. My question was why? Now I know the rules and I understand. And as I understand the milliseconds that it takes to go here, say, it might make a little bit sense that I would want to print my options over there, because by the time Chicago sees it, San Francisco sees it, New York sees it, and every other exchange that's out there, it's going to take a millisecond to actually get there. In that millisecond, like I told you, it might as well be 10 hours. You might as well be on a flight to California, sitting there reading a book. That's the technology these days. So they're allowed to then get the stock a little bit ahead. Now, they buy the stock. So now they're in a situation where you're bidding for calls. They buy stock. If the stock goes up, you never get filled on your calls. So you're sitting there going, I didn't get filled. And now you're trying to pay up. Okay. And guess what? They're waiting for you up there at whatever you want. So go ahead.
So what if I just cancel my order then? And they bought stock?
Perfect. So now you cancel your order. That takes a millisecond too. And guess what? The minute that the machine can sort of see, hey, cancel your order, it's like cancel it. They especially if the stock came off a little bit, they bought a little stock. They might fill you at 118, and they say, "Oh no, we filled. You got filled. Cancel up. It got filled." Okay, so they're leaning. It's called leaning on your stock. Leaning on your stock. Now, it's totally legal. If this is legal, it's just because of technology. It is, there's pros and there's cons. You want great bid offers. You want tight markets. You got to let the market makers win a little bit, right? You see that if they lose, what happens? You can't even trade. People say, I want to get rid of the shorts. Get rid of the short selling should be banned. Well, be careful what you wish for, because if short selling is banned, then there's no options trading, right? Because the market makers can't short stock to protect. There's a whole that, we'll let the market makers, but everybody else no. But the market makers will just create products that will actually, then they could sell to the people who want to short. So it's hard to get around that, but that's a whole nother story. But here, what you're saying, what you've brought up is another situation, which is called, now people's brains are thinking and goes, well, wait a second. Maybe I could just bid for calls, watch the stock go up, and maybe I could sell stock. Now that's illegal. That's called spoofing. Okay, you can look it up. Actually, there is a pretty good, I wouldn't say great, it's not great production, but spoofing, there's a Bloomberg documentary. It's like 20 minutes, but it's pretty cool. Basically, the government blamed spoofing on some 21-year-old kid who made a lot of money in London. It's a great 20 minutes, but it explains what spoofing is. Essentially, it's that Marco's not allowed to just bid, and then cancel, bid, cancel, bid, cancel, bid, cancel. If you do that, then the government might, now doing it with one lot, nobody's going to care. But when you start becoming a big company, and in this case, or a big private investor, and you start saying, I want to bid for 10,000 shares of American Airlines, and the stock moves up 10 cents, and then you actually sell 200 shares, because you're always bidding a lot more things up, you get caught for spoofing. That's illegal. You're not allowed to do that. But the funny part about the whole thing is that who's it hurting? When you go bid for 10,000 shares, you know who buys in front of you? The computers. They buy a penny ahead of you. So they basically, you bid for 10,000, they buy stock ahead of you. So the rule is almost there to protect these guys who are doing this to you. It's crazy. But again, it's a catch-22. If you don't allow them to win, the markets are very tight in the options market. And if you want tight markets, somebody's got to win, right? You get a chance to they're playing a different game, but what I described is all the legality of it. And they changed the rules. Frankly, in 2004, I'll give you, I don't know if we have time. I'll give you one quick story.
It's a good
Okay, I'll give you one quick story
Why not?
from when I was at Bank of America. You're trading against the best in the world, right? It's a cat and mouse game. They want to kill me sometimes, I want to beat them, right? I'm trading volatility, they're trading direction. So they would come in and, in 2003, okay, they would come in and say, I want to buy 20,000 of these calls. Okay, so 50 delta, it's 500,000 shares. Well, how am I going to buy 500,000 shares of this stock? Right here. I need it. I need to buy it right here because that's right here is where the premium is here and the stock is here. I got to trade both right there. Well, I'm sitting on the phone. Maybe I'm actually on the phone and I'm saying, hey, how are you? Hey, I don't want to talk. I want to buy 20,000 of these calls. Whoa, okay, yeah. Hold on one second. Which calls? I want to buy Micron calls. Micron Feb 80s. Okay. Like tapping on my desk, just making but I have my screen there. I'm looking. I was allowed in 2003 to actually buy the stock. So while I'm on the phone, I know he's trying to buy 20,000 Micron calls. I got to buy 500,000 shares of stock. I could actually be on the phone. You were allowed. It was legal. All right. They didn't have this rule where I had to print in 2004. So I can go in there and buy the stock. And he'd be like, who's buying the stock? What's going on? Why is the stock going up? And I'm like, I don't know. I have no idea. What are you doing? Are you doing it? It's a cat and mouse, right? Because he's trying to put me on a trade. And then what do? They buy the stock. So in 2004, it changed. The rules changed. And now I had to actually print. I wasn't allowed to touch my computer, the stock. I had to actually print 20,000 options on the exchange. By this time, on this computer trading, the ICE and all these things, it wasn't as mature. Back then, you had to go to the broker. Okay, so this is what I had to do. 20,000, the market's 110, 120. You want to buy 20,000? I'll show you 20,000 at 130. That's too much. Okay, how about 1 1/4? I'll show you 20,000 1 1/4 because it's a good client. We want to keep him. We want to keep him coming. Fine, I'll pay 20,000 1 1/4. Great. You know what I had to do? I literally had to go give 20,000 to the broker. Call the broker up. Hey, go buy 20,000 of these at pay 1 1/4. I will have at Bank of America will sell what they have to. Try to get me out of this trade. I don't want to do this trade. Try to have the floor. Okay. The broker then put down the phone and there was a relay person to person or run into the crowd and he'd run in and he'd say, Micron, Feb 80 calls, how do you make them? The crowd's like, now he's not trying to give up my whole picture. He said, how do you make them? 110, 120, 2,500. And then he'd say, I need more. Micron, I need more. He goes, well, what do you want to do? Now he's got to say, okay, if he says he's a buyer, there's 10 guys in the crowd. So, buyer, yeah, you want more? What do? They run to the stock. They don't have anything to do with it. Now that's information out there that I'm a buyer of 25,000. All of a sudden, while I'm waiting for this whole thing to happen and come back to me to say, you bought, what are they going to tell me? They say, you bought 20,000, you sold 15,000. Okay. I'm 45 seconds, a minute behind everybody else. The stock is already running. I'm sitting there waiting. The stock is running. The minute he says to me, you're filled on 15,000, you got 20,000 filled, you did 15. Now I can go buy the stock. Wow. You see, that put me in a complete disadvantage. To who? The market makers. Who changed that rule? Who made that rule in existence? The market makers went down there and they said, you're not allowed to do that. We pay good money to be down here. It's like, but somebody is front running. So this is the game. So these are the rules. When it becomes law and it's ruled, then you can't do it. But prior to 2004, you were allowed to do it. But what was happening is the market makers got angry. It's their house, their game, the exchanges, they pay for the seats. And if you want to trade on the Chicago exchange, trade options, then you got to follow our rules. And as a board, we're ruling that it has to print before you're allowed. And then they lobby and makes it law and it's illegal. So you can't do it. But now, because that was 45 seconds, that was a long time, and a minute, a long time. We're talking about a millisecond now. And in a millisecond, like I said, it's like flying from New York to LA. It might as well be, a luxury cruise ship for the weekend. These guys have a millisecond is the whole world these days. So it's something to think about. Your question is valid. And the more you trade, the more you start feeling like somebody's in front of me. I can't get it. It was offered there. I tried to get it. I can't get it. I didn't get filled. And then the thing runs and it's going to happen. And it's going to happen more in times like this when the market makers aren't making any money. Mm-hmm. So keep that in mind. That's my market making lesson for the day.
Nice.
Any questions? Great. Any questions from people?
Yeah, there's a few. Okay, let me pick two. I have here. So Pam says, can you see it?
Go ahead, Pam. Pam's got a lot of questions today. Ah, is that why they split my trade into several lots to fill it all when I placed a limit order? It could be. Yes, it could very well be. It could be that the machines. Look, these are sophisticated machines, but again, it's being directed, especially if you're in Robinhood or anywhere that sells the order flow. The order is given to someone, and look, they're doing the best job within the framework that they need to be in. So, if the market is 110, 120, and you say limit order pay 120, and they pay 119, that's a bonus because they beat your limit order. Like they get credit for saying, oh, we beat limit orders 90% of the time. It's like the airline saying, we are always on time. We always leave the gate on time. Meanwhile, they might be on the runway for 3 hours, but they just want to leave the gate 1 minute before so that they can say for their stats around time. So same type of logic. But yes, these orders can get split up into many different exchanges. And again, it's nothing that what people is this. So what can we do about it? There's very little you can do. I mean, you're trading against the machine, and you're trading using machines, and you're trading with machines. So the machines they're all over. It's not like the machine's going to figure you out, right? It's not going to be difficult for you to keep bidding, and the person handling the order is going to say, this isn't real. So instead of buying 200 shares, I'm going to buy 50 because I don't think this is real, right? At some point, what you're doing is trying to trick a machine, and that's hard to do over time.
Right.
Okay. So yes, things are split up. Options orders are split up. You're going to get fills 1, 2, 3. You're trying to buy a 5 lot 1, 1, 3, or all 5 on one exchange, whatever. But yes.
Cool. Nice.
All right. Cool, man. Any
that's
other
all the questions I see? And if you guys have any other questions, so just leave them here. I'll read them, and then tomorrow we can address some.
Awesome. All right. So we talked about TEVA, CLDR, NCLH. I gave you the IFF and DXC. I think it's important. I think it's an important example just to show you what we're doing at OptionsGeek. Yes. Win or lose, it doesn't matter. Going into the trade, was it the right trade? I would argue that DXC was the right trade.
Cool.
All right. Be good.
Awesome. Thank you, Felix. You too. Everybody who's not subscribed, please subscribe. And if you are, please share. And we want more people here. We want more questions and more insight. Today was great. Thanks. Bye.
Thank you.